In the year 2000, Enron was worth $7 billion. Fortune magazine had named it America's most innovative company 6 years in a row. Wall Street loved it, investors trusted it, employees believed in it. Every single bit of it was a lie. Most corporate scandals are about one bad decision, one moment of greed, one failed bet. Enron was different. Enron was a fraud. From almost the very beginning, built not on energy but on illusion, on numbers that didn't exist, on profits that were never real, on a culture so obsessed with appearing successful that it destroyed everything and everyone in its path. This is the story of how the smartest guys in the room turned out to be the most dangerous. Here's what almost nobody remembers about Enron. It didn't start as a fraud. It started as a genuinely revolutionary idea, and that's what made it so deadly. Enron was founded in 1995 in Houston, Texas, a merger of two natural gas pipeline companies, boring, unglamorous, regulated. Then a man named Jeff Skilling arrived. Skilling had a vision that was genuinely brilliant. Instead of just moving gas through pipes, why not trade it? Buy gas here, sell it there, profit from the difference. Turn natural gas into a financial product like stocks or bonds. In the early 1990s, Congress deregulated the energy markets, and Enron was perfectly positioned. Within a few years, Enron wasn't just an energy company, it was a trading empire. It moved into electricity, into broadband, into water. By 2000, it was the seventh largest company in the United States, revenues of $100 billion to 20,000 employees. A stock price that had risen 1,040% in a decade. Wall Street couldn't get enough, and Jeff Skilling wanted more. But here's the problem with building an empire on trading. You have to keep winning every single quarter. And when Enron started losing, they did something that would eventually destroy everything. They started lying. Enron's accountants had discovered a loophole, something called mark-to-market accounting. Normally, a company records profit when it actually receives money. Mark-to-market allowed Enron to record the projected future profits of a deal the moment the contract was signed, not when the money arrived, not if the money arrived, the moment the ink was dry. So Enron could sign a 20-year broadband contract and immediately book all 20 years of projected profits, even if the project never made a single dollar, even if it was a complete failure, and when the reality didn't match the projections. They hid the losses in special purpose entities, shell companies with exotic names like Chuko, LJM, Cayman, and Raptor. Enron moved billions of dollars of debt off its balance sheet, making the company look profitable when it was bleeding. The man who designed most of these structures was Enron's CFO, Andrew Fastow. He wasn't just hiding losses, he was secretly skimming millions from the very shell companies he created, stealing from his own theft. And through all of this, one of the world's most respected accounting firms signed off on every number, Arthur Andersen, a firm that had built its reputation over 80-90 years on one word: integrity. In August 2000, Jeff Skilling abruptly resigned as CEO. He cited personal reasons. The stock began to fall. Then a Fortune magazine reporter named Bethany McLean asked a simple question that no one on Wall Street had thought to ask. How exactly does Enron make its money? Enron had essentially been a Ponzi scheme, and in its final days, it looted the retirement funds of its own employees to buy a little more time. Wikipedia: when the wall came down, it came down fast. In October 2000, when Enron restated its earnings, wiping $600 million in previously reported profits, the stock collapsed. By December 2000, Enron had filed for bankruptcy, at the time the largest bankruptcy in American history. 20,000 employees lost their jobs. Their retirement savings, invested in Enron stock, were gone, while executives had been quietly selling their shares for months. Kenneth Lay, Jeff Skilling, Andrew Fastow, the smartest guys in the room, walked away with over $1 billion between them. Their employees walked away with nothing. Enron didn't collapse because of one bad decision. It collapsed because of a culture that rewarded appearance over reality, that punished anyone who asked uncomfortable questions, that promoted the people most willing to cross the line. until the line disappeared entirely. The company was linked with several illegal schemes, including deliberately instigating the California energy crisis to drive up utility prices at the expense of ordinary Americans. Enron wasn't an accident. It was a choice, made every day, by people who believed they were too smart to get caught. And here's what history tells us: they always believe that. Every empire that has ever collapsed, from Rome to the British pound to Lehman Brothers, has been filled with people who were absolutely certain that the rules didn't apply to them. They were wrong. Subscribe to Empire Collapse because the next Enron is already out there, calling itself the smartest guy in the room.